Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about FIRSTENERGY CORP quarterly report. FirstEnergy Corp offers a range of businesses and services including electricity generation from various sources such as coal-fired, nuclear, hydroelectric, wind, and solar power distribution of electricity through its extensive network of lines and facilities, transmission of electricity, over 24,143 miles of transmission line miles services to customers in 6 states: Ohio, Pennsylvania, New Jersey, West Virginia, Maryland, and New York. The recent increase in FirstEnergy Corp's stock price can be attributed to several key factors. The company's strong Q3 2025 earnings performance, with EPS surpassing analyst expectations by 10.67%, was a significant contributor. Additionally, the upward revision of full-year 2025 EPS guidance to $2.50 to $2.56 per share demonstrates confidence in continued financial health. The announcement of increased capital investment plans, including a 10% increase in the 2025 program to $5.5 billion, has also boosted investor confidence. Furthermore, positive analyst upgrades and price target increases from institutions such as Scotiabank, Barclays, Morgan Stanley, and Mizuho have further supported the stock's growth. The company's consistent dividend payments and growth, strong revenue growth, and net income increase have also contributed to a positive sentiment around FirstEnergy Corp. Overall, these factors have collectively driven the stock price upward over the past year, with an 8.55% return over the past year and an impressive 21.83% return year-to-date. The primary drivers of revenue growth for JCP&L can be attributed to several key factors. The distribution segment has seen significant growth, driven by increased rate base, customer usage, demand, and rider revenues associated with regulated investment programs. Additionally, higher non-shopping generation auction rates have contributed to revenue growth in the retail generation sales segment. Furthermore, the transmission segment has experienced growth due to a higher rate base and recovery of higher transmission operating expenses. On the other hand, revenue decline can be attributed to lower customer usage and demand for distribution services, as well as decreased sales volumes in wholesale generation sales. It is essential for JCP&L to monitor these trends and adjust its strategies accordingly to maintain revenue growth and mitigate potential declines. Net income and profit margins experienced significant changes between 2024 and 2025. Net income increased by 14%, rising from $466 million to $532 million, with a notable increase of $76 million from $158 million to $234 million. Profit margins also saw improvements, with operating income margin increasing by 2.4% and net income margin rising by 0.3%. However, the distribution segment's profit margin decreased slightly from 11.1% to 10.9%, while the transmission segment's profit margin dropped significantly from 45.6% to 38.5%. These changes suggest a mixed performance across different segments, with overall net income and operating income margins showing growth, but some areas experiencing decline in profitability. The company is generating a significant amount of positive operating cash flow, with a notable increase from $1,847 million in 2024 to $2,564 million in 2025. This substantial growth indicates a strong financial performance and ability to generate cash from its core operations. The consistent figures on page 18 and 100 further reinforce the company's stable and improving cash generation capabilities. The company's debt level and interest expenses have undergone significant changes. The total liabilities have increased by $3,376 million from $38,324 million in 2024 to $41,700 million in 2025 Long-term debt has also risen from $22,496 million to $25,510 million over the same period. Notably, interest expenses have seen a substantial increase. The total interest expense rose by $19 million from $74 million in 2024 to $93 million in 2025. This significant change is attributed to higher interest rates on new long-term debt issuances, including convertible notes. As a result, the company's financial obligations have increased, indicating a shift towards more expensive borrowing options. The financial performance of various segments and regions has shown mixed results. The residential segment in distribution services, commercial segment in integrated retail generation and distribution services, ATSI, transmission segment, and residential revenue have all performed well, with growth rates ranging from +4% to +9%. On the other hand, the industrial segment in distribution services, wholesale segment in integrated retail generation and distribution services, corporate/other, eliminations and reconciling adjustments, and wholesale revenue have underperformed, with decline rates of up to -74%. Regionally, residential electric distribution has seen a 2% increase, while commercial electric distribution has experienced a 1.1% increase. FirstEnergy's management is optimistic about the company's future prospects, driven by its focus on regulated investment programs. The company is investing heavily in capital expenditures, including a significant increase of $844 million compared to last year, indicating a commitment to growth. To finance these investments, FirstEnergy has issued new debt securities, demonstrating its ability to secure funding. The company is also prioritizing sustainability goals, aiming to reduce CO2 emissions by 90% below 2005 levels by 2045. This focus on environmental responsibility aligns with state regulations and initiatives, such as energy efficiency and GHG reductions in Maryland. Overall, FirstEnergy's strategy centers around investing in regulated transmission investments, implementing base rate cases, and complying with state regulations while advancing its sustainability goals. Acquisitions and divestitures overview. Brookfield acquired a significant stake in FET through two transactions. Firstly, they purchased a 49.9% equity interest for $7 billion. Later, FE acquired an additional 50.1% equity interest in FET. These acquisitions demonstrate Brookfield's strategic investment in the energy sector. On the other hand, there were several divestitures made by the company. In July 2025, Global Holdings sold its 33-1/3% equity ownership to WMB Marketing Ventures and Pinedale LLC. Additionally, McElroy's run CCR impoundment facility and adjacent dry landfill were transferred to a subsidiary of Ida Power, LLC, in March 2025. These divestitures indicate the company's efforts to restructure its assets and focus on core operations. The company has a history of paying dividends to its shareholders. In fact, it has made significant payments in recent years. As of September 30, 2025, the company had $257 million in dividends payable, while at the end of 2024, this amount was $245 million. Furthermore, the company received an additional $60 million from Global Holding in 2024 as a dividend payment. These transactions demonstrate the company's commitment to rewarding its shareholders through regular dividend payments. Concerns about inventory buildup and supply chain disruption. The financial summary highlights several concerns regarding inventory buildup and supply chain disruption. One major concern is that supply lead times have not fully returned to pre-pandemic levels, potentially leading to service disruptions, page 31. Additionally, increased fuel costs, $24 million, purchased power costs, $147 million and $85 million, and other operating expenses, $22 million, may indicate strain on the distribution services and supply chain. Uncertainty around global trade policy and tariffs also poses a risk to supply chains, page 96. Furthermore, significant increases in purchase power costs, $67 million and $154 million, and provision for depreciation, $26 million, from Q3 2024 to Q3 2025, and from 2024 to 2025, respectively, may indicate potential issues with inventory buildup or supply chain disruption. These scattered concerns throughout the report suggest that there are indeed potential issues with inventory buildup and supply chain disruption. That concludes the financial summary for FIRSTENERGY CORP. Feel free to comment below, and I will be happy to answer them when possible.